Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking Karoon Energy, ASX code KAR. G'day, Elio. Tell us about this company.
Yeah, g'day, Phil. Look, it's interesting because I know bloody oil. Why on earth would you talk about an oiler? And in fact, it's our second largest producer on the exchange, so it can't be ignored. And I suppose I'm going back to the past where I can remember looking at Karoon when it was back Karoon Gas before they bought the Barnwana project in Brazil in I think it was 2020, and then they became a fully fledged oil producer. And they've had a bit of corporate news in recent times as well. So in that sort of, how shall I put it, in that context, that's why we're looking at Karoon Energy today.
I didn't realise it was the second largest, so it is a pretty big player.
Yeah, it's a pretty big player. Of course, the majority of what it produces actually is offshore rather than onshore. But in terms of Australia, it's often not noticed because of that fact. But in terms of the actual...
Everyone looks at Woodside, don't they, in this space?
Yeah, to be honest, Phil, my foot is tired kicking into Woodside. Although, to be fair, they're the biggest in the room, as it were, and no one really, wants to be too harsh on the business. But it's a tough commodity. It's a tough space. But in the case of Karoon Energy, in particular, a recent announcement of theirs, there could be some potential production upside, and hence why we're talking about it today.
So are geopolitical tensions impacting the oil price at the moment?
Look, Phil, I would have thought that. And traditionally, it is something we look at when it comes to oil prices. But you know what? October 7 really changed that. Notwithstanding the tensions in the Middle East, I mean, we knew that the, what do they call it, Iranian-backed Houthi rebels, or whatever the case may be, were going to be creating a bit of strife in the Red Sea, and therefore you would have thought that oil prices would have spiked on the back of the news of what was occurring there. Well, if I can rewind it, what actually happened, for those that don't remember, is that the oil price went down. No, it didn't go up. And that probably tells you that it is more of a trading tool rather than a sign of geopolitical tensions, because let's face it, they haven't gone away. They're unlikely to go away anytime soon. Yet the oil price moves to the beat of its own drum. In fact, I've seen it rise in recent times on the back of some of the US driving season as July 4th over there comes online. So it'll move for whatever reason it does. OPEC keeps holding these cuts forever and a day, and yet the oil price hardly really moves relative to where they want it to be. So I do think that, yes, whilst a lot of people look at it as a barometer for geopolitical tensions, the reality is it is disconnected and it moves to the beat of its own drum. And investors need to remember that.
I guess listeners would be wondering, if the oil price hasn't been going up that much, why we're paying so much at the Bowser.
Well, you see, there's something called refinery margins, and they've gone through the roof ever since the whole Ukraine-Russia thing. So there's a whole other story in regards to that, which is probably why companies like Ampol and Viva Energy should be making a lot more money now than what they have been. But that's another story.
So I saw this headline when I was researching this episode that said crude futures buoyed by a wider risk-on mood in equity markets as the US benchmark S&P 500 reaches record highs. What's the dynamic going on there when equity markets are going up?
Yeah, look, I'm going to make a stab in the dark on this one, Phil, but I reckon you are old enough to remember April 2020, because back then, May futures contracts for oil actually went negative. That's right. So, in effect, they were actually paying people to take oil off their hands, as it were. And, I mean, this is you never really hear about it, particularly as a long-only fund manager. And really, this is because there were concerns that, the storage capacity would actually run out. And remember, this was on the eve of what ended up being the great shutdown across the entire world on the back of what was brought on by COVID. So, there was obviously a few things playing out there. And because of that reason, that's why you'll often see the oil price attached to this. So, yes, whilst that geopolitical, as I alluded to, that geopolitical risk, as it were, does play a role it is not the entire role. So I hasten to caution investors in thinking that you can immediately tie the movement in the oil price to what's occurring in the world. Because, yes, obviously, anything that disrupts supply is going to have an impact on the price because the demand of it still remains at a stable level. Reduce supply, price goes up. I mean, it's economics 101. So whilst that will be, to a degree, a certain impact, I think there's been enough proof points in recent history to suggest to all of us that it's not really that way, that, when it's a commodity that the traders have got a hold of. And in fact, most market commentators were writing a headline going back to after the price has moved rather than before the price has moved, which is a whole other issue.
Yeah, I think it's interesting, isn't it, just to keep in mind that sometimes you read a headline and you take it on face value, but it is someone just writing that headline. And that particular headline was referring to the price movement on the markets yesterday in crude futures. And
Exactly.
they're looking for a reason to tie it to.
I remember the great excuse me if I'm wrong here, but I believe the quote is attached to Warren Buffett, and it was loosely along the lines of, commentators will often fill your ears, but very rarely will they fill your wallets. And I think that really rings home, particularly in regards to what you just mentioned, Phil, because seriously, anyone's guess is as good as mine as to why the price of black gold goes up or down. And again, it's just something we've got to be cognizant of whenever we're invested in one of these businesses.
So it looks like oil and gas are a long way from being stranded assets, which we were looking at a couple of years ago.
Well, to be fair, I mean, if you look at the Woodsides of the world, for example, and a whole range of others, over the very long term, oil and gas stocks have pretty much not had the greatest of runs. In fact, they've lagged pretty much everyone else. And to be honest, I wouldn't normally put my money in them, not even yours, Phil, in regards to these businesses. They just don't have the type of, well, if they're channel bound at best, and you could sort of pick tops and bottoms of the channel if you want, but ultimately you're going to really struggle to find that, because even though the potential price is uncapped and we've had hyperinflation and all that sort of stuff, and as you alluded to, we're paying more at the Bowser and all those sorts of things, oil stocks just don't seem to reflect that positivity. And once you become big, like a Woodside, for example, and you then get into the Gulf of Mexico, most investors, they sort of sit there and go, oh, well, that's pretty typical of what you would expect a very large oil play or oil stock to do. Even same like BHP. That's why they don't buy individual mines. They go out for Anglo-American, as it were. They need an acquisition that actually does something to their balance sheet rather than a hit and hope, which, it's a roll of the dice as to whether there's any success or not. So that, I think investors, again, would be very, reminded of that. I mean, OPEC have had production cuts, or OPEC Plus, or whatever it's referred to, has had production cuts on oil for something like over 12 months. And yet the oil price has not really reflected that. So the likes of Aramco might be disappointed. And of course, they're the Saudi-owned energy enterprise over there. But I mean, there's not much we could really do. So it is somewhat stranded, as it were. But ultimately, there will be supply and demand factors that drive the actual price of it over the longer term, even though over the shorter term, investors will be left frustrated.
So Karoon is in the Stockopedia NAPS portfolio, which we're 6 months through the 2024 NAPS portfolio, aren't we? How's it looking in that? And remind listeners what the NAPS portfolio is first.
Yeah, I think I'll do that. As the acronym would suggest, it's the No Admin Portfolio System. So in effect, what we do is we select two of every one of the sectors that Thomson Reuters actually defines and covers, with the exception of telecommunications, where there's not really a big sector, nor is there utility. So I only get one from those. And also we include two REITs, because effectively Thomson Reuters doesn't have those. But anyway, the idea is, in effect, you buy the stocks that are the highest ranking within each of the sectors and you hold them, come thick or thin. Like, they may be great, like Southern Cross Electrical, for example, but they could be disastrous, like Mount Gibson Iron Ore, for example. So, but either way, these cyclical factors that move price and all that, we block out and we ignore. And effectively, we make the selection. And then at the end of the year, we then look at those selections, see how they've gone as a collective, clean the slate, and then we start again. So that's what the NAPS No Admin Portfolio System actually is. Now, Karoon Energy actually sits within that, because it was one of the higher ranked energy stocks. And it's of the fact, the other one I might add, and just to prove that it's not always about price, Beach Energy is the other one, and they've had a pretty torrid time, as have Karoon Energy in recent history. But in the case of a Karoon Energy, they've held pretty well in regards to their overall structure. I mean, notwithstanding that we would like to see quality a little higher than where it is. Currently, it's at 75. The value on a Karoon Energy is exceptional at the moment. It rates a 96, and it's spinning cash, and we know that. And there's a few reasons why we think they'll continue to do that going forward. And even though the price over a 24-month basis has done pretty poorly, on a 1-month basis, it's actually gone up a little bit. And further to that, analysts are starting to lift their earnings estimates somewhat on the back of some recent developments and updates from the company. And therefore, it's been actually lifted from a momentum perspective to 73, which gives it an overall rank of 94. So it's not in the upper echelon, but it is amongst the higher ones of the energy producers, and hence why we're talking about it today. So it was back then, it still is now. Even though the price is down, we still think this is a good business. And when you look at a value rank of 96, it tells you that this is cheap. But as a price taker, we need to again accept that often the direction of its price is going to be a symptom of what its underlying commodity does. And in the case of oil, we've seen a rebound in oil, so we've seen a rebound in price. And vice versa, when oil goes down, guess what also happens to the price of Karoon Energy, especially now that they've got Bawana, their Brazilian facility, back on track. And they've also got their Who Dat and Dome acquisition, which we'll talk about in a moment.
Are you picking shares on gut instinct, buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB.
Okay, let's get down and dirty with the financials. What are they looking like?
Yeah, they're looking pretty good. I mean, obviously, we need to consider the fact that estimates are pretty important in this one here, Phil, because obviously the acquisition of Who Dat Dome, that is a Gulf of Mexico asset, and it gives them a 30% interest in that project. And it's important to note that this is important for two reasons. One, it's rather large, but two, it diversifies them away from Brazil, which was obviously one of those things that, I don't know whether you read the common media and press, but a lot of people were very upset about that being a single domiciled business. So Who Dat Dare is their first branch out of that. And they really needed to do that because, as I alluded to, they were spinning cash and they've got to do something with it. You either pay it in dividends or you go buy something. And this is not a dividend payer. It's not for the dividend investor, that's for sure. So therefore, they had to go out and buy something. And on the surface, it seems good. I mean, they had to take on a lot of debt, don't get me wrong. And in an environment where we've seen rising interest rates globally, it ain't the best time to do it. Although that said, I did read reports today that in the US and potentially globally, inflation seems to be easing. So therefore, we could see global rates come down, notwithstanding the stickiness here in our domestic market, but globally, which is where someone like a Karoon goes and taps when it's looking for money, it's obviously coming down. So when we look at estimates, I mean, we're looking at a company with strong revenue growth. They're expected over the 2024 year to grow revenue up to $822 million. That is in US, of course. We're talking about net profit also rising and earnings per share also tracking up, although about 6.34% is what that is expected as. There's a bit of capital expenditure on the back of Who Dat and Dome. Ultimately, what we're looking at here is that next production upkick. So the Bawana project in Brazil is very good, and it's been generating quite consistently and solidly for the business. And I alluded to the fact that as Karoon Gas, they were pretty much an explorer, right? They were sort of digging holes and they were hoping to find something, running pipes, seismic pipes down the ground, getting them the tests up there, et cetera, et cetera. And really, that was a bit of a mug's game, as it were. But when they bought these assets off Petrobras, they turned from a cash negative business to a cash positive business. And that has really been seen in the numbers going forward. And this acquisition is also in the Gulf of Mexico is also going to be another kicker to this business. And it's one of the advantages you have by not being top of the tree, as it were. Any acquisition you make can have a sizable impact on your overall business. Now, I did allude to the fact that the price hasn't been all that stellar since its peak, I should say, which was actually towards the October 2023, which for many stocks was actually a down point, if anything. But in this instance here, it is counter-cyclical, so it's gone against the market. Part of that is because of the oil price coming back, as we've talked about, but also part of that is the fact that they've needed the debt to go out and buy this acquisition. But then it makes sense. So whether it's someone like a Karoon Energy or a coal producer or whoever it is, when you're talking about assets that have incredibly strong cash generation, you want to go out and you want to go buy them. So Karoon Energy in recent times has provided a relatively solid update. I won't say it was necessarily shoot the lights out. So they produced their quarterly update in recent times, Phil, which was actually quite good. I mean, they did temper that expectation around its price by saying that they were rated, or their debt was rated a B, both by the fine people at S&P Global and at Fitch Ratings, which ultimately flows through to the amount that they can raise capital at, or raise debt funding, as it were. So obviously that is not the greatest, but they have started drilling on the east wall of Who Dat, which is expected to yield some pretty solid results and contribute quite positively to the production that they've got at Bawana, and the company said as much in that quarterly update. The massive re-rate that we've seen in regards to that debt, yes, that's possibly an issue. But, if I can't control the commodity price, the one thing I do want to control is an increase in production. And I see that with the Karoon Energy. It's not like they're trying to get more out of their existing assets. They've actually got new assets to go out and increase production that way. Of course, they'll then go about optimizing and making it more efficient as time goes on. But in the initial hit, they're increasing the size of resource that they have. And they do that in an environment where they're actually positive and have a relatively low risk score. So even with the huge amounts of debt that they've got, they're currently rated as cautious. The Piotrowski F score currently sits at 6. That's 6 out of 9 for those wondering. And that is definitely not a disastrous. And the other pleasing thing is that given that strong cash flow that they're generating, much of that is making its way to its profitability. So the Beanish M score, as we call it, that is actually low at the moment, which means that much of the profit is translating to cash. What you don't want is a hell of a lot of profit and very little cash, because then it's like, hang on, who's having fun here? The accountants or those that are drinking the Kool-Aid? But in our view, we actually feel quite comfortable there in that regard. And it's trading on a forecast PE, Bill, of 4.2, so it's cheap. It's dirt cheap, probably cheaper than buying at the Bowser, actually, now that you raise it. And it's on an EV to EBITDA of 2.7 times. But it will always have that price taker overhang on it, and it'll be hampered somewhat by the fact that it is such a large commodity-focused business, notwithstanding the production increases that we hold quite high hopes for, as it were. And again, in that latest quarterly, were reaffirmed by the business and we felt quite comfortable. So the value score is really where it's at in regards to a Karoon. I couldn't, for love or money, convince anyone that the share price is on an upward trajectory, and quality, whilst it's very good at 75, isn't the absolute ultimate. And again, we just need to be aware and conscious of that. But I also think that part of that is due to the large amount of debt that they've had to raise, but the acquisition makes sense and it's spitting out cash, and they should, all things going well, pay that off relatively easily.
You've alluded many times to the Piotrowski F-score, but we've never actually explained to listeners what it is. Can you just briefly tell us about that?
Yeah, sure. So the Piotrowski F-score was developed by a chap by the name of Joseph Piotrowski, funnily enough, whilst he was at Stanford University. And ultimately, it was a means of assessing a business whereby effectively, if a company was meeting certain key criteria, then it was in relatively good operational health and doing all the right things that you want to see. And it's pretty basic in terms of its actual calculation. I mean, things that are rates on, for example, like net income, So basically, is the net income this year greater than the previous year? Is operating cash flow better this year than it was the previous year? Return on assets, quality of earnings, which is basically where the cash flow exceeding income. Doesn't often happen, so it's always good when you do see it, but nonetheless, it is one of the ratings in this score. There's also elements in regards to leverage and the like and liquidity, and there's also operating efficiency that are measured. But ultimately, these benchmarks are then basically scored. If they pass or fail, it's pretty binary. And ultimately, what you want to do is you want to get, in effect, 6 or greater in our view, in order to be considered a good operational business. If you've got less than that, then there's obviously challenges that'll be had. And then we have, the bankruptcy risk score by Professor Ed Altman, which also overlays that. And then we also have the Beanishem score, which we then look at the cash generation. Assuming it's generating positive cash, of course, Phil, if it's not doing that, then it's going to be in a lot of strife and probably go cap in hand looking to investors. So in this instance here with Karoon Energy, it's 6 out of 9. So it's a pass. It's definitely in the green zone. That's where we want it to be. So in regards to Karoon Energy, when you look at its Piotrowski score, I mentioned that it was 6 out of 9, which was a pass. However, when you go down and look at the depth of the numbers, that debt is really dragging it back. So unfortunately, it doesn't get full marks because obviously long-term debt is actually increasing. It's not reducing or remaining stable. And there's a potential that they could be raising funds from shareholders, but they've chosen not to because debt is actually the cheapest form of financing, irrespective of the B rating. And therefore, they think that with their strong cash generation, they'll be able to pay it back. So, and then as I alluded to, there were some problems at Barwana, which have now been resolved, and that also dragged that score back. So overall, it's a pass mark. We definitely look for that as a bit of a tick, as it were, and hence why that's contributed to the overall quality score, irrespective of the fact that the Altman Z score, the amount of debt it carries, and a few other metrics aren't necessarily that squeaky clean, but it still represents deep value in our view.
Elio D'Amato, thank you very much for joining me.
Thank you, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.
And let's face it, oils are oils. They're not ain't oils, they are oils. Crude oil is the same. It's a commodity.
Yeah. showing your age there, Phil. Yes,
I know,
oil.
yeah.
Oils ain't oils. That's a ripper, I'll add that one. I tell you, those good ads, the ones they nailed, like if you can remember them, you
this many years later, this many decades later.
There's got to be value in it. And yes, the old Castrol ads, they still exist too, don't they? I think they do amongst the inner sanctum of the rev heads and the like. But yeah, that marketing agency, they absolutely nailed that one.